What's going on, everyone? It is Paul, the 920 trader with 920 Trading Decoded. Today is, well, it really doesn't matter what the day is, folks. This video corresponds with the newsletter that's, coming out right now. It's coming out right now. So Saturday, every Saturday morning, 11 o'clock Eastern time, the trading newsletter comes out, and we have a corresponding video, again, corresponding, it goes along with the newsletter. So what is the specific topic for today? Well, we had one of our members. I ask the members on a regular basis, what would you like me to talk about in my trading newsletter and consequently in the video? And so I take recommendations or suggestions, if you will. If I don't know what I'm talking about, folks, I say, hey, listen, I don't know what I'm talking about. So, but today I do. So the question was today, actually this week, it was, well, I'm just going to ask, it is, when do you cut your losses? Well, it's very easy. In my book, cutting your losses is something you should know before you ever put on the trade. I call it, and it's not just that I call it, but it's called predefining your risk. So what does predefining your risk look like? Well, it's essentially this. You predefine your risk before you ever put on the play. So you have to know exactly where you're going to get out of the trade before you go in. If you're not doing that, folks, you're gambling. You're throwing money away. You're throwing crap on the wall and you're calling it artwork. You can't do that. You must know exactly to the penny where you are going to take yourself out of the trade before you put it on. You can't change that either, folks, without a specific known area to stop, to take yourself out of the trade when it goes against you. Because, folks, let's face it, we have trades that go against us all the time. If you never take a loss, you're not trading. I'll just tell you that right now. If you never take a loss, you're not trading. It's not reasonable to assume anybody can put on 100% of profitable trades. It's never going to happen. It's just not going to happen. So how do we do that? So it is my opinion, and again, I'm a 920 trader, so I use the 9 and I use the 20 to generate those buy and sell signals, and I use the 9 and 20 to get in and to get out of the trades. But here's the kind of the provision. If we take, as 920 traders, if we can, number one, identify the zones out of which to take trades, okay, so major levels as I call them, and use the 920, use both of those things together. It's the same strategy, but we are limiting ourselves to crossovers only at specific levels. So what are those specific levels? Well, you got pre-market high, you've got pre-market low. Those are two levels. Okay, those are major levels. You have, or what I use 30-minute double tops. Those are called supply zones. That's where price action has in the past rejected out of that high level and come back down. Again, that's called a supply zone. So at the same time, I also use what are called demand zones. So 30-minute double bottoms. So in the past, and in most recent past, where has price bounced out of that area? In other words, it's a demand zone. I demand you sell me your share so we can drive it back up. So that's what it is. So those are the levels out of which we need to take our place, and those levels only. So here's the thing. The closer you can get, again, a crossover, and there's multiple ways to play the 920 crossover. The closer you can get to that specific level, and again, a major level, however you define it, it can be any one of those types of levels, or it can be an intraday level. So an intraday demand zone, an intraday, that's during the day supply zone. That could be a 5-minute double bottom, 5-minute double top, something like that. Now, just remember this, folks, the higher the time frame, the stronger the level. So if you got a 5-minute double bottom or a 5-minute double top, generally those are pretty good. But if it's a 15-minute or a 30-minute double top, guess what? Those, generally speaking, are better levels. And again, I'm speaking in general terms. That's not always the case, but that's why we're speaking in general terms. So there's nothing that happens 100% of the time at all. So what we are going to do to predefine that risk, this is where the rubber meets the road, folks. Put on trades as close to that level as we can. So let's say it's 20 cents away. So you get a cross or you get a fishtail play. And the fishtail, that is the space between the 9 and the 20. So let's say we're looking for calls. We have a demand zone. We're going down into that demand zone. You get a curl. You get that candle, you get that tail on the bottom of the candle. Your 9's starting to curl up. And then you you find support at that 30-minute zone, that demand zone. You get that curl, but your 20 is still up top. So your 9's down here, your 20 is up here. That's called the fishtail. If we can take a fishtail play at that demand zone, let's say the candle closes 15 cents above your specific level, but you're still between the 9 and the 20, that's perfect. I mean, you're jumping the cross of the 920 in some instances by multiple minutes. And if you can do that, folks, catch those trades directly out of that demand zone or that supply zone up top, and again, out of the fishtail, those are generally really, really nice trades. Now, the one thing to always look out for on that type, and again, it's a fishtail trade, you always, always, always look for when you're approaching the 20, depending on how far away it is, when you're approaching the 20 to the upside, you're always going to look at that 20 as resistance, because a lot of times, folks, we'll bounce into that 20 reject and then come back to the downside to kind of reconfirm into put. So we always have to watch that 20. So again, that's the best way to do it right there. And again, that's called a fishtail play. The second thing is, and that's an aggressive play. It's absolutely an aggressive play, but it is out of a major level. It's out of a major level. Now, second thing we can do is call it a double cross. So a double cross happens when we, to the upside, we open below the 9 and close above the 20. When we get a double cross, we have multiple things working in our favor. Okay, so a double cross at a major level. So it's that same 30-minute demand zone down low. You get a double cross, which again, you get that tail on the bottom of a stick or a candle. It pushes down, and then you get the double cross up. So it opens below the 9, closes above the 20, and it closes above your major level. So it closes into that demand zone. You have multiple things going on right there. You're closing above the 9, you're closing above the 20, and you're closing above that major level right there. So you can define your risk one of 3 different ways. Number one, you've got the 20, which is directly below you. And then you've got the 9, which is directly below that. And then you've got that really, really strong demand zone down there. So again, the closer you can get, when those are bunched up like that, let's say they're 15, 20 cents between, let's say, that demand zone and the 20, you got to put on that trade, folks. What's your risk at that point? It's 20 cents. It's the distance from the close of that candle down to that major level. Again, folks, it's major level for a reason. Now, what happens when you hit your stop? Some folks use mechanical stops, and some folks, I use mental stops on everything. So I mark it in and mark it out of all of my trades. But why do I do that? Well, I don't like wicks to take me up to the upside, and I don't like tails to take me out to the downside. Now, the downside to the mechanical stops is when it moves against you, it can move against you rather quickly. So you always have to be, that the first couple of minutes of that trade, always kind of be on the lookout for the reversal or a trade going against you at that specific level. But again, there's that. So that is double cross. So you get the fishtail play. Then you have the double cross, and then the next way to play it, that's a conservative cross. But again, we want to be as close as we can be to that major level. So you get a cross, maybe you get a cross of the 9 below that demand zone, and then you get up to that, you're crossing the 20, and then you just barely get into that demand zone. So the 9 and 20 are below the demand zone. So it kind of pushes up above that demand zone, and that's where you put on the trade at that point. So what do you have? Let's say you're 15 cents away after the candle closed, 15 cents away from that demand zone. So your major level is right there. Well, again, you've got 3 different levels of stop. The further you get away from the candle, from the close of that candle, the more it's going to hurt when they pull back. And remember, folks, the further you are away from the 9, the more the pullbacks will get you. So again, you're out of that, you're into that demand zone. You've got that demand zone. You get that major level directly below you. That's your risk. So it's 15 cents or 20 cents or whatever it is. But again, if you hit your stop, you have to get out of the trade. You just have to, folks. And again, it doesn't matter. Individual trades do not matter in the big scheme of things. But you've heard me say it before, while individual trades don't matter, they must be treated as though they are the most important trade you will ever put on in your life. If you don't, do every trade like that. Okay, if you don't, yeah, every trade. If you, I've kind of lost that word. Treat. If you don't treat every single trade as though it is the most important trade you will ever put on your life, folks, you're gambling. You're just absolutely, it's a small contract. It's a small position size. I don't really, if it blows past my stop, I really don't care. That's really bad. That's very bad for your training. For your trading, and mentally it will really get you, because that'll be kind of the death by 1,000 cuts. You have enough of those that come up where, well, you predefine your risk, but you don't stop out for whatever reason, because it's a small position, or it doesn't matter, or you don't care. You've made your profit. You just kind of got this one on the line kind of as a flyer at the end of the day, folks. That's gambling. And you get enough of those little cuts like that, you're gonna feel it from a mental standpoint. So again, folks, always predefine that risk and treat each individual trade as though it's the most important trade that you'll ever put on in your life. Now, how do you predefine your risk when you're not at a major level? Well, that's actually quite interesting. So, as it happens every now and again, folks, let's say you miss your entry. You're away from your computer. You miss your entry, and it's taking off without you. So what do? Well, you wait. What do you wait for? Well, you can wait for a couple of different things. Number one, you can wait for a pullback to a major level, whether it's to the downside or to the upside. Or you can kind of wait for that fresh cross. If you get a fresh cross, but you're not at a major level, let's say you're a training day to the upside or the downside, it doesn't matter. If you're on a training day and you get a little pullback and you get a fresh cross to the upside, where do you predefine that risk? Well, that's real easy. I call it an ignition candle. I didn't write about this in the newsletter, but it's called an ignition candle. It's the candle that got you into the trade. If the candle that got you into the trade is good enough to get you in, it's got to be bad enough to take you out. Well, what does that look like? Well, let's say you're in an uptrending market and you get a little pullback and you get a double cross to the upside. Well, you have a couple of things working in your favor. So you've got the 9 as support and you have the 20 as support. Now, if you take a fishtail play right there, there's a lot of space between the 9 and the 20 and you're not at a major level. A good part of the time you can pretty much count on rejection off of the 20 in the opposite way of your play. So again, if it's not at a major level, for the most part, leave it alone, unless it's a really nice trending day, and then you're going to catch it. Let's say double cross to the upside. The candle, let's say it's a 15-cent candle or a 25-cent candle. Okay, you close the candle and your risk is the close below that candle. Now, when can you get back into the trade? So let's say you have that trade, you confirm into the trade because it does it on a fishtail or a double cross or a conservative play out of a demand zone, out of a supply zone, or whatever. But it comes back down, you stop out of the trade. So what happens if it goes back up or down, depending on the direction of the play? What happens if you reconfirm into the play? Do you get back into the trade or not? The answer to that is a resounding yes. Because again, folks, individual trades don't matter. But we must treat each individual trade as though it's the most important trade we will ever put on in our life. So if you reconfirm into that trade, put on the trade. Bottom line, put on the trade. So many times what happens, and I hear it from traders all the time. Well, generally speaking, here's what happens. One of two things happens. Number one, a lot of people don't take the trade off the table because they think that it's going to come back and pick them up. That's really bad. The second thing that happens, if you stop out because it hits your predetermined level of risk, that predefined level of risk, and you reconfirm back into that trade, most people don't put on that trade. They just don't. That's just a reality, because they're thinking in their mind, they're thinking, you know what, the last time I did this, I took a loss. And so what that does is that leads people to not put on that next trade because their signal was still there. It was there, maybe got a little bit more pullback, that reconfirm. They don't put on the trade. And the result of them not putting on the trade is they sit back and they're like, oh no, what do I do now? What do most traders do at that point? They start chasing trades. We can't chase trades, folks. We're not dogs. We don't eat out of a bowl. We don't bark. We're not dogs, folks. Don't chase trades. So what you have to do in that situation is go, you know what? Put that in the memory bank. I got confirmed into that trade again, but for whatever reason, I wasn't willing to pull the trigger. So put on that trade, folks. Just put on that trade. If your edge presents itself, you are compelled to put on the trade. Now, I didn't trade. I didn't trade yesterday. I didn't trade today. Because I had stuff going on yesterday and I was out for the first 2 hours of the day, and then I had a doctor's appointment today. So I didn't trade today, being Friday. Okay, this is coming out Saturday, but I didn't trade. Didn't really miss much in the market yesterday. I didn't really like the price action, so I didn't trade. And today I wasn't really available, and it looks like I didn't miss very much. But again, folks, predefine your risk before you ever put on the trade, and that's how you do it. Now, if you are too far away from a major level, leave it alone. If you get one of those 60 or 70 or 80 cent candles, but it's above your specific level, what you can do is you can wait for a pullback and then get back into that trade. But the further you are away from the origination of that play at your major level, the more risk you are putting on. And also, you can every now and again take an intra candle position. I do that every now and again, if I got something that's really strong. But those tend to, on big candles, those tend to come back and kind of bite you. Only because on the big candle, when you get a lot of movement, 60, 70, 80 cent, a dollar candle, what happens is implied volatility necessarily increases. So a couple of things. If you wait for that candle to close and then automatically jump in, you will be underwater on that plate immediately, particularly if you market into that trade, because you're getting the worst possible fill. And secondly, when it pulls back a little bit, it not only pulls back, but you're losing to implied volatility. So the IV crush happens almost immediately at the end of that large candle. Every now and again, you get lucky and you get another large candle, and you can kind of market out of that trade and do well on it. But again, stacking probabilities in our favor, folks. So again, let's recap. Major levels only. 920 crosses. Again, you've got a fishtail, you've got a double cross, you've got a conservative play, and you got to predefine your risk. So that's it, folks. That is it. Now, if you like our videos, you guys know the deal. Go ahead and smash that like button. Leave us a comment. We always appreciate the comments. Oh, don't forget to turn on your notifications and share. We would greatly appreciate you sharing it with your friends, neighbors, trading community, all of the above, folks. So please, please, please share. Also, if you are interested in live daily trading, head on over to a live trading Discord. It's called Trading Decoded. The link for that is down below. So check out that link. We go over these trades all day long, folks. So all day long, we're going over these trades. The beauty is we're calling them out and we're going over them all day long. And again, we are so convinced that you will get a lot of value out of what we do. We're going to give you that first week for free. So what do you have to lose? Nothing. Now, if you're interested in the 920 crossover strategy, the entire strategy is there at no cost to you other than your time. What's your time worth? Well, your time is worth what your time is worth. But you owe it to yourself to go over there, 920trading.com. The entire strategy is there for the entire world to see at no cost to you other than your time. So there it is, folks. That's it. I mean, that's it. Talked about quite a lot today. So I hope you got a lot of value out of what we're talking about today. We really appreciate you very much. I hope everybody has a great weekend. We got a long weekend. Monday, the market is closed. But anyway, I hope everybody has a great weekend, folks. I hope everybody's having a good new year and have a great weekend. And you guys know the rest. Have a great day. Have a great weekend. And until next time, folks, we will see you in the markets.